Welcome, introducing myself, Von Ritchie, Sales Consultant of Your Land Developments. In partnership with Mortgage Domain, we have a very special guest to answer commonly asked questions around finance when embarking on buying property. This is the first episode of a 3-part mini-series around borrowing and finance. Introducing Mark Polatkesan, Director and Senior Mortgage Broker. Mark, would you want to tell us a little bit about yourself?
Yeah, absolutely. My name is Mark Polatkesan. I'm the Director and Senior Mortgage Broker at Mortgage Domain. Mortgage Domain are a construction-focused brokerage, which means we specialise in arranging finance for home and land. We deal a lot with new home buyers, first home buyers, and our business is geared towards, assisting clients purchase land and also build their dream homes. The business has been around for 7 years now. I've been a mortgage broker myself for the last 18 years. We're a business of 16 brokers and 10 admin support, and we're quite a sizable business. As I mentioned before, we do focus heavily on home and land finance.
Beautiful. Thank you for joining us, Mark. Today's presentation, we're going to cover a number of topics. Main topics that we're going to be looking at is introduction to a mortgage broker and the benefits of using one, deposit requirements and borrowing capacity, and unexpected costs and saving tips. Let's dive in. So, Mark, what is a broker? What is a broker's role, and what should I think about when using one?
It's a great question. It's something that we get often asked. So the role of a mortgage broker, or I suppose what a broker is the conduit between yourself as a customer and the banks or lenders. We're basically there to assist you facilitate a loan, but obviously we want to make sure that when we do make a recommendation for a loan, it actually suits your requirements and your long-term objectives. We, as a group, have access to 45 different lenders. So obviously we would have a conversation with you as a customer or a client just to work out obviously what your requirements are, and then we make a recommendation off the back of that. We basically also assist you with all the relevant paperwork that needs to be prepared and presented to the bank, just to make sure that the process is as streamlined as possible for you. As I mentioned before, we do have access to quite a few different lenders and quite a few different products as well. So it's all about making sure that the product and the lender that we're recommending suits you from a policy perspective, but also your long-term objectives as well, as I mentioned. We also want to make sure that we can get you the most competitive rate. We're making sure that it all still suits your needs as well.
Beautiful, thank you. And how much deposit do I need? And how much do I need to have saved? What is the difference between genuine savings and gifted money?
Yeah, all great questions. When it comes to the deposit, it does really vary from bank to bank and also along with your situation. I suppose the short answer is there are lenders out there in the market that can offer a 95% loan, which means you need a 5% deposit. That can be reduced, however, if you do have a guarantor. So a guarantor would basically be, let's say, mum and dad that have their property available and have sufficient equity held in that property, and they're willing to be a guarantor and provide their home as security against your purchase. In those cases, we can go up to 100 to 105% of the property's value. But once again, some lenders may require you to have a slightly larger deposit as well. So some banks may ask for a 10%, 15 or 20%, and also boils down to whether or not you want to pay lender's mortgage insurance. With your question about genuine savings, so what genuine savings is basically a savings pattern held over a period of time. So some banks, when you have less than a 20% deposit, or sometimes as low as 10%, the banks may want to see a savings pattern held over a period of 3 or 6 months. They want to make sure that you've got the ability to save your own money, and usually that deposit needs to equate to 5% of the purchase price. Some banks can actually waive that requirement if you are renting, and they'll use your rental history as a savings pattern to offset any genuine savings requirements. But once again, it doesn't get around having to physically pay the deposit. You still will need that in most cases. It just doesn't need to be held for a period of time if you are renting. But once again, this policy does differ from bank to bank. Just to explain what lender's mortgage insurance is, or LMI as it's commonly known, it's basically an insurance policy, to put in simple terms. It's an insurance policy against a bank's money which they're lending to you to mitigate any potential risk. Mortgage insurance is normally involved when you have less than a 20% deposit, and it becomes more expensive the closer you get to the bank's maximum threshold, which is usually about 95%. The closer you are to 80%, the mortgage insurance policy can change. Usually with mortgage insurance, it is a one-off cost unless you refinance and change institutions at a later point in time and you don't have that 20% in equity held.
So it does sound, Mark, like it's quite key that there are good saving patterns, and the more that you have, the better.
Yeah, absolutely. Having a larger deposit is definitely going to give you much more lending options available to you. It sometimes can also result in a cheaper interest rate as well.
Excellent. Great. Thank you. How do I work out my borrowing capacity, and how will it impact my property search? I think we covered that a little bit, but if you can take us through that, that would be fantastic.
I suppose when I'm having a conversation with a client, borrowing capacity can be determined two different ways. One, what the banks are prepared to lend you, but also what are you comfortable with repaying back as well. So we do have quite a lot of conversation with our clients to say, like, the bank will lend you, let's say it's $800,000, but then when we work out what the clients actually are comfortable with repaying each month, that might only equate to a $600,000 loan. So I suppose to answer that question, I would definitely go and work out what you can comfortably afford repaying each month. And obviously that will probably then determine what you're able to borrow, but also see if that's in line with what the maximum capacity is with that particular bank. The banks, usually when they assess your mortgage and your ability to borrow, there are certain buffers that they'll add onto your borrowing capacity as well. So usually if you're getting a delivery rate or a home loan rate of, let's say it's 2%, the banks, when they assess your application, they'll actually load that interest rate by, let's say it's 3% at the moment. So they assess your affordability on a 5% interest rate. The reason why they do that is they want to make sure that you're still in a position to afford that loan in the event of interest rate fluctuation as well. So that's one of the buffers that they have implemented. On top of that, they have what we call debt to income ratio as well. So debt to income ratio, at the moment, most banks have a benchmark of 7 times. So 7 times your income normally will result in the maximum loan that the banks will be comfortable with lending to you. Lenders, when they do assess your lending or your loan application, they do want to see things such as pay slips or any type of income document. So if you are self-employed, that would then mean maybe a tax return, a notice of assessment, and financials. Another thing that they do want to see is a breakdown of your living expenses as well. So people with same levels of income, you'll find that sometimes their borrowing capacity can differ because one's got a higher living expense per month compared to the next applicant. So that is something that will definitely impact your ability to borrow. You also want to have a look to see what liabilities can you actually clear up. So having an active credit card, for instance, even if you don't use it, will reduce how much you can borrow from the bank. So if there are some things that you can tidy up, such as Afterpay, ZipPay, credit card limits that aren't being used, you may want to revisit them just to see if there's something you could potentially reduce. And as I mentioned before, the maximum capacity is not always going to be aligned with what you're able to repay to the bank. Establish a budget based on what you're comfortable with repaying.
Definitely an amazing point there to look at, what you are comfortable with, and sitting down with someone like yourself to actually go through this. Thank you. We'll go to the next question. What are the costs and fees should I think about when I'm buying land off the plan?
Yep, great question. One of the main costs associated with purchasing property would be stamp duty. One of the benefits of buying land and also then building would then be that stamp duty is only applicable on the land component. If you are a first home buyer, at the moment, there is no stamp duty that's being charged, provided your land value doesn't exceed $600,000 in Victoria. On top of that, you also have what we call transfer of land costs. So that's another government-related duty associated with the value of the land. You've got a conveyancer or solicitor cost as well. So depending on who you use, that cost could be anywhere from $800 to about $1,500 from what we see. You've also got registration costs as well, which could be a couple $100. So yeah, these are costs over and above the purchase of the land and also the building. Also, some of the other items that you might want to sort of include over and above the land and building costs, the things that let's say the builder may not necessarily do. What we see quite often, so most builders may not include fencing. With fencing, it is a shared cost between yourself and your neighbour. So most builders won't actually include that in their overall pricing. Landscaping as well, because obviously it's a massive variable between what you might want versus the next person. Obviously, you want to get something customized to your requirements. So landscaping will be a cost over and above the standard sort of build cost, and also things like blinds and also concreting as well. So when you're doing your shopping around, it's probably important that you get quotes for these individual items, just so you know and you're aware of what these costs are going to be when the house is ready for you for it to be handed over to you once construction is completed. We do also quite often get clients to arrange quotes for things maybe such as fencing, landscaping, and also concrete. In most cases, we're able to actually borrow these into the actual loan, provided we submit these quotes to the valuer and they include it in the overall valuation. Just keep that in mind.
Beautiful. I really love the fact that you threw blinds in there, Mark, because there are little things that I think buyers do need to factor in above the land price. So thank you so much. Have you got any great saving tips as I work towards buying my first home? You did mention some of them, but have you got a few that I think you'd love to share with customers about, saving when they're really looking at what they're going to be comfortable with as well?
Yeah, absolutely. It's something that I actually do quite often. I like to print out my monthly bank statements and actually go through each transaction, because I find quite often, like, we subscribe to memberships or subscriptions or whatever the case may be, and obviously these costs can accumulate over time if you don't review them. So just go through your bank statements, I suppose once a month or once a quarter even, and just go through any costs that you could potentially cut out from your living expenses, right? So whether it's magazine subscriptions that you don't read or gym memberships that you don't attend, whatever the case is, maybe sort of review these and see if you can cut them off. Any potential discretionary spending, so maybe eating out or going out, for a drink or dinner or whatever the case may be. If there's something you can potentially cut out from there as well, because obviously the higher your living expenses, the less you can borrow and the less surplus cash you'll have at the end of the month. Maybe you want to review that as well. I always recommend having a clear budget as well. So just go through, I suppose, your cost per month, what the income is coming in every month as well, and just see what the surplus is and see if you can actually save that money as well. One of the beauties about buying land and also building would be you've got a bit of a time frame up your sleeve in most cases. So let's say you commit to a land contract today and the settlement's not going to occur until 12 months later. I would probably encourage that you continue to save a deposit in that time, because obviously your deposit's not required until the actual settlement date or the title date. So if you can save yourself another $5,000, $10,000, $15,000, $20,000 in that time, it means that obviously that's less money you would need to borrow. It also would reduce things like mortgage insurance as well.
Thank you so much. I'm sure that a lot of buyers would really appreciate that and those tips.
You're welcome.
So next time, we've got some more topics to cover. And the topics that we will be covering in our next mini-series is loan structures and interest rates, lender's mortgage insurance, and finance pre-approvals. So if you really did love this mini-series, this episode, we welcome you to join our next episode on brokers and preparing to buy property. So you can get in touch. You can get in touch with us if you have any more questions about this session. With Your Land Developments, you can reach out to melbourne@yourland.com. And with Mortgage Domain, you can contact Mark and his team direct at hello@mortgagedomain.com.au. Thank you, and thank you for joining us. And we will see you next time in our next mini-series. Thank you.